What I want to talk through today is how someone can actually live off of $130,000 of income and pay just over $0 of federal income tax due. To understand how you can implement this strategy, you need to understand how taxes work on the different types of accounts that you may have. We've done many different videos talking about the different sources of income that you have in retirement, but what can be complicating can also present an opportunity is the way that income is taxed in retirement. Now, state taxes will vary across all 50 states, so understand that we're not going to so much dive into that as much today as we will focus on the IRS and the federal tax system. Let's first start with how earned income is taxed. For the majority of folks who are working, they will receive some level of earned income. Earned income is an example of ordinary income. So earned income you may be familiar with: wages, salaries, tips, commissions, could be self-employment income. Essentially, it's any income that's derived from working. That doesn't necessarily mean that all ordinary income is earned income. Ordinary income can also include things such as pension benefits. It can include interest from your CDs, your savings accounts, your money markets, and it can also include a portion of your Social Security benefit. Ordinary income utilizes a progressive tax rate, and you're probably familiar with the tax bracket. So for both married filing jointly and single tax filers, they follow this ordinary income bracket. They are what's known as marginal tax brackets, meaning that the amount of income that you make within that bracket is taxed at the corresponding percentage. It doesn't mean that all of your income is taxed at that percentage. Ordinary income also has a standard deduction applied to it, or you can itemize your deductions. Now, standard deduction can also be increased slightly if you're over the age of 65 or if you are blind. If you're married filing jointly and both individuals fall under these criteria, the standard deduction can be increased even higher. But in our progressive tax system, ordinary income isn't the only example of income that's taxed. We also have what are known as long-term capital gains. And these long-term capital gains are taxed at a slightly different bracket. They are similar in that they're progressive taxes. However, the rates themselves are far more favorable than the ordinary income tax brackets are. As you can see here, this is an example of a married filing jointly tax bracket. Long-term capital gains will apply when you hold an asset for over a year and then you sell off that asset in which a gain has occurred. The profit of the sale is what's taxed. Generally speaking, you'll also have a cost basis within this as well. So anything that you contributed with after-tax dollars has increased your basis, you would not owe federal tax on. Long-term capital gains would apply to things such as mutual funds, stocks and bonds. It could also apply to real estate if it's not your primary residence. Now, your primary residence could be taxed via long-term capital gain, but that's a subject for another video. And what we're going to walk through right now is an example of somebody who's able to utilize distributions in a smart way. To set the stage, we're going to use Donna and Donald Donaldson, and they have $1 million in Donald's pre-tax IRA. They also have a joint account of $375,000. We're going to say that the cost basis in this is $100,000, meaning that there's $275,000 of long-term capital gain that they have not yet realized. We're also going to say that neither are collecting Social Security at this point, neither are working. And just to keep this example simple, they don't have any interest or dividends within their accounts or outside of any other accounts that they may have. Let's walk through 3 different scenarios to actually see how this would work. So as you can see here, we're utilizing the 2025 tax year, and we're using current law. The only income that they're utilizing is a $130,000 withdrawal from Donald's IRA. Being that they don't have any other income, as you can see here, whether it be short or long-term capital gains, their total income is going to be $130,000. So if we scroll down just a little bit further, what we'll see is that the standard deduction would apply. The standard deduction for 2025 for the 2 individuals who are both over the age of 65 is $33,200. So the math is fairly simple. You take the $130,000 and you subtract the standard deduction of $33,200. That gives a total taxable income of $96,800. The total tax that they would need to pay is $11,139. They fall into the marginal tax bracket at the 12% rate, and they're near the top of that 12% rate. Their effective tax rate is at 11.5%, between the 10 and the 12% rates. This is pretty standard and cookie cutter if all they were living off of was just pre-tax retirement income. But what if we took the withdrawal from their joint account? So as again, we see it's a 2025 tax year, and the calculation is the current law. They're not taking any income from their IRA this year. Instead, they're taking all of the income as a long-term capital gain of $130,000. Their total capital gain is $130,000 because we're not including any short-term capital gains, which, by the way, short-term capital gains would be taxed at ordinary income rates. Instead, as we continue to scroll down, we see that the total income is the same, as the adjusted gross income as well. Now, what we also can apply to this income is the standard deduction. It would apply to both the ordinary income and also the long-term capital gain. If we scroll down just a little bit further, we'll see that the taxable income is exactly the same. The difference, though, is the amount of tax that would be due. The total tax that would be due is $15. And the way that we utilize that is we subtract the standard deduction from their total income. We then apply that to the long-term capital gains rates. And as you can see there, just barely over that first threshold. Since this is a marginal tax bracket, much like the ordinary income tax brackets are, only a very small percentage of their gain would be taxed, thus creating a $15 federal tax bill that would be due. It's no secret that long-term capital gains are taxed at more favorable rates than ordinary income would be. But what we also want to then consider is there a way that we can actually blend these two together? Everything that's in the pre-tax account would be subject to tax once the withdrawal takes place. So therefore, we don't necessarily just want to sit on that pre-tax account, because we will have to pay that tax eventually, whether that comes out as a required minimum distribution, whether they decide to take voluntary distributions throughout the rest of their lifetime, or if they were to leave this to their heirs, such as their kids or whomever that would be. So instead, what we can show is a blended scenario. And here you'll see that we're only going to take an IRA distribution up to the standard deduction of $33,200. We're then going to scroll down and we see that we're only going to recognize up to $96,800 of long-term capital gain. That gets us to the same income of $130,000 in the previous two examples. But much like we saw in that middle column with only the long-term capital gains planning, the standard deduction applies, the total income is the same, but as we're going to see here, the total tax is actually going to be the same as that middle column as well. The reason this occurs is we apply the $33,200 to our ordinary income tax rates first. Therefore, we're taking advantage of the standard deduction with the less favorable brackets in the ordinary income. We're then utilizing all of the 0% tax bracket in the long-term capital gains and just a very slight bleed over. And again, it results into a $15 tax bill due at the federal level. As mentioned at the offset of the video, we don't necessarily just want to utilize this and say that this should be the strategy that the Donaldsons should be considering every single year. But what we do want to utilize is a withdrawal strategy that benefits them on both their investment planning and their long-term tax liability. Being that they're in such a low tax bracket and they have a high balance inside their pre-tax account, it may make sense for them based on other goals to consider something like Roth conversions. I'm linking to a video right now to show you how that could work in practice for them. But what we also want to consider is at some point they're going to be taking Social Security income. We want to make sure that we're creating a strategy that balances income, the investment plannings, and a tax strategy all in one. By doing that, we're going to look at this from both a year-to-year basis, but also the course of their long-term goals. And that's what we focus on when it comes to planning. You can check out the link in the description to set up a call with our office to go through how that planning would work. If you're curious about learning more about your best retirement, I'm showing 2 other videos that you'll be able to see here to give you a better idea of how you can make sure that you're able to see your investments last while also enjoying and getting full usage out of the savings that you've made to this point.